Welcome to the daily update, where I'll go over the action in the market for Friday, March 28th, and we'll see how things look for Monday, March 31st. Pretty significant down day. The markets, the confidence that the consumer has, they're really nervous. They don't really know what to make of all these changes that are going on. And we're going down, and support that we had bounced up off of, we're going back down to that again. And that's usually not a good sign. If we come down to a support level, hit that and go, we usually don't come back to that level for a while, if ever. And now we're back down where we were just a few days ago, and things are shifting over more negative. We lost the 20 period moving average. We still are negative in the intermediate term. We're mixed in the long term. The trend is still positive, but we're below the 200-day simple moving average. And a lot of that is just uncertainty. You've got these tariffs that are supposed to be unveiled or actually go into action this week on April 2nd. And there's some hope that maybe there'll be some last minute negotiating that goes on. But if that doesn't work out, then the tariffs are going to go in. And there's a lot of uncertainty. Everybody seems to have an opinion about this, but what's really going to happen, we don't know that yet. Now, the US used to bring in money by use of tariffs, and so it's not like this hasn't ever been done before. And there's a lot of tariffs that have, or a lot of countries that have tariffs against the US where it's more one-sided, where the tariff that's imposed on the US is greater than if they bring products to the US. So um, the reciprocal nature of things might kick more into gear as well. And that's producing some unsettledness. And when you go through big change, people are unsettled. They're used to the status quo. They're used to the way things are. It might not be good, or it might not be the best way that they like things, but at least they know it. They understand it. They can deal with it. They've adjusted to it. Well, that's kind of what the market's going through right now, is this adjustment and uncertainty. And when there's uncertainty, there's selling. Okay, so right at the open, we had a lower open. It wasn't too bad, but we just picked up and just kept going right after the open. We quickly fell down below S1 at 56.65, down below S2 at 56.38. We found some short-term support just for a little while, a few minutes, at 5600, another round number. Then, after slowing down or catching its breath, we kept declining down below 5600 at to S3 at 55.76, and we closed just about at that level. So we were down 1.97% on, get this, below average volume. That's what we're seeing right now. You have hedge funds in there, you have some big money in there doing some things, but this isn't necessarily the smart money. They're doing things, they always do, but we're not seeing an awful lot of action right now. They're just kind of letting the markets duke it out as they decide, do we want to go up? Do we want to go down? Until we get a clearer picture about where we think things are going to happen going into the future that lasts more than one day or so, we're not really willing to come in and buy. All right, so as I said, we're negative now in the short. We've remained negative in the intermediate terms, and interest rates seem to be cooperating a bit there. And we got the core PCE, and it came in as expected, but they round up. See, when they go, 2.6%, well, it's really 2.59387. I mean, it goes out a number of decimals, and it gets either rounded up or rounded down. That's what I do with the support levels. I round it up if it's above 50, round below if it's below 50. Well, even though the headline number is the same, it actually got rounded up to the higher end of that number, and that's producing the annual rate to make it go up a little bit as well. The market didn't like that, and couple that with the all this tariff stuff going on, and it ended up being a negative day. Okay, so there are escalating inflation concerns and deteriorating consumer confidence or sentiment. That's what we're seeing in the report that came out. And I'll show you that chart. I have two different charts to show you of consumer sentiment. And that's what people are fearing right now, which is both things are negative. Inflation going up, and we're not feeling real confident about things right now. And we're below the 20 period simple moving average with the S&P, mega caps, and growth were quite weak. And if they're going down, the market's going down. And the parabolic SAR has now turned over negative. That's one of the primary indicators that I use. It had been hanging on to positive, not after Friday. It now has a dot on top. And we're back above 20 with the VIX at 2165. We do show really no list as far as our indicators, the short-term ones, but we're getting far away already from that 20 period simple moving average, the boom indicator that measures that we're far away. And in the intermediate term, we're far away from the 50 period moving average. That's really it right now. And we still have a non-confirmed Hindenburg-Ullman. We have until the 31st. Now, with that Hindenburg chart that I get, there's a 1 day lag. So we're not going to find out until Tuesday when I prepare things for Wednesday if that Hindenburg-Ullman has actually been confirmed. But if we don't see another spike on the 31st or generated on the 28th because of the down day, then this will fall off the books. Okay, and then no changes to the overall scenario. The Fed really likes the core PCE as far as inflation. And since that got rounded up with the inflation component, that's spooking the markets. And the dollar was down, interest rates were down. For all last 3 weeks or so, we've been right around this 4.25%. We were at 4.24, then now we're at 4.26 with the 10-year yield, where we had been at 4.37. So interest rates really came down. And sentiment, we're back under that 25 level again. We were there for a few weeks. We bounced out of it for a few days. Now we're back down below 25. I should make this extreme negative at 22, where we had been at 27. And we're inverted again with the 10 to the 3 month yield curve. I'm pointing that out for right now. We're negative with our trend. And it looked like midway through the week last week, we had a chance at crossing over positive, but we needed to see a follow through day that didn't happen. And so then we saw Friday be rather significantly down. And so now the negative trend is not turning into a positive trend. We're still above 20, even though it's below its moving average. It shows a weakening trend. It is still a trend, and it can kick into gear at any given time. And with the down day, the bias is positive and our momentum, I'm switching that over to negative again. We just didn't see any real follow through. And then Friday ended up being quite negative. All right. We got personal income up more, 0.8% than expected. They is twice as much. They thought it would come in up 0.4%. Last time it was up 0.7%. So this was kind of a hot number, which you'd think, okay, folks are bringing in more money. Maybe that's a good thing. Personal spending was also up, but less than expected. It's like, okay, they're keeping the money. They're not spending it necessarily. It came in up 0.4%. They expected 0.6%. Last time it was down 0.3%. The prices came in as expected, up 0.3%, and also what we saw last time. This is the core where it came in as expected, but again, they had to round it up this time, up 0.4%. They expected it to be up 0.4%, but probably the lower range of the four. And then prior was up 0.3%. Consumer sentiment. This also happened a month ago and happened 2 months ago when the market started to, it's like, people aren't feeling really good about things. You need to have confidence in what's going on. Well, it came in at 57, where the last time we had the report, it was at 57.9. So it's still down, but it got revised down. Okay, so here's a chart of personal income and spending year over year. We're right about at that 5% level, coming up a little bit here, not just under 5% with the income, just over 5% with the spending. Of course, that means they're spending more than they're bringing in on an annual basis. And then core inflation starting to tick back up here on an annualized basis. And that market doesn't like that. And then month over month, though, it came up from the negative reading that we saw last time. Here's sentiment, where the blue line, they're jumbled up here because they're all going down together. Lower as far as sentiment, lower as far as the purple line, how people are feeling right now, and the yellow line is how people are looking out into the future. Here's the chart that I show, still coming in down here at 57. I also plot this with the 2-year Treasury yield, where usually when these are going up or down together, that's more of a healthy sign. Okay, now I have a few extra charts in this from Isabel Net because I didn't do a video for Friday. So I do have some extra ones here. I try to just pick out those ones that I felt are relevant. So I didn't necessarily include all of them here. This is also investor sentiment, retail and institutional composite, where, it's still above here, above this 50%, 50% level, but it has been coming down, at least lately. So it's getting rather pessimistic. And then the 1 year out expectations of stock prices, it's the lowest decline ever. Okay, because it got down pretty much this low after Trump 1.0 tariffs and then after the COVID crash. And it's getting, because this has been drawn out longer. And even though COVID got drawn out as far as the lockdowns, we crashed down for a few days and then V bounced up out of that. That didn't really last all that long. This has been drawn out. It kind of started to kick in late 2024, and it's been pretty much the story in 2025. And then the US share of a global public equity market, it's recently declined. Well, yeah, it's going to. And we're seeing things in Europe stronger now than in the US. So it's been coming down, and earnings are actually coming down as well. And I've been talking about that in a lot of the videos. And then this just shows I sometimes I follow the E-mini futures or the S&P. Now I focus on the S&P index, and then alongside that is the SPY, which is the ETF that goes with the S&P. But there's, thousands and thousands of options contracts, and there's mutual funds, there's other ETFs. Well, there's also futures contracts, and you have the big full-size contract, and that's pretty expensive for just anybody to do. So they have this E-mini, which is like a smaller version of that. And this is just showing the bid-ask contract size, and it's been going down lately. So we're kind of hitting the lower end of this currently. All right, then what do you think the probability of there being a recession in the next 10 months? About 20 to 30% chance, according to this survey. If you're a perma bear, you're over here in the 80%. If you're a perma bull, thinking everything will turn around, you're down here in the 10% or less category. Wall Street's wide-ranging stock forecasts. Yeah, all the way up here over 7,000 with Oppenheimer. And then you have Stifel down here at the lowest. So they're all over the map. Where at the beginning of 2025, I posted something like this, and there were some deviations, there were some outliers, but for the most part, folks were coming in at about the same area that they thought 2025 would go to. And that's what happens. We go up and forecasts look really rosy. We go down, forecasts start turning more pessimistic. It's I don't pay any attention to these. I don't use any of these to make a decision. Some people do, but I'm not a forecaster because you can see these are professionals that do this all the time, and their track record is pretty abysmal. All right, then breakdown of the current equity ownership, the top 1%. So probably if you're in that category, you're not listening to this video. About half of all stocks are the top 1%. And then we have the 50 to 90th percent, that's 11.75%. And then 90 to 99th, that's 37.26% here. And then the bottom 50% only own 1%. So this is more middle, upper to lower middle class over here, where this is the real wealthy over on this other side. Then this is how things performed since inauguration. The blue line, that's where we're at right now. And I'm sorry, the blue line is the average. The red line is where we're at right now. And then this is going back over a number of years and plotting all this out where it looks like a spider web here. And then growth investment ratio of US versus global markets. So this is, are they going to spend money? Because there's been a lot of announcements, especially when it comes to AI, that you got a lot of these high tech companies. They're putting billions and billions of dollars into AI. And that's for the S&P together, that's 42%, where it's 26% in other global markets. All right, then Magnificent Seven set for worst quarter. Okay, it's so far it's down. I mean, actually Monday will be the end of the quarter, and unless we have just like a 10% up day, they're probably going to be down for January, February, March of 2025. Then, over the following time horizons, would you rather own US or European equities? A lot of folks are picking up on the fact that things are stronger in Europe. Looking out 1 year, 85%, they'd rather own European stocks. But if you say, okay, how about 5 years down the road, they would still rather own US stocks. All right, found a few interesting charts here. The fundamental, sorry, I have to move this right here. Fundamental long or short net leverage. And folks are pretty leveraged short right now, which could actually end up being positive when we get a really extreme negative reading like this. And then this is what's driving things down. Semiconductors are weak, tech is weak. And so, and I do show a version of the SOX index, the Philadelphia Stock Exchange Semiconductor Index, and then the world semiconductor sales. They're all going down. And that's why we're seeing pressure in some of the high tech companies. And policy uncertainty, it continues rising. So, right here, this is the 10% correction. And we're getting kind of close to that 10% area again after Friday's decline. And then this is the current one. This is the light blue area right here. And then this is more or less what could happen if we have a further decline here based on historical prices as well. So it just means that, it's a little scary right now because we're getting close to that 10% level. We're breaking through support that usually we bounce up off of. Sentiment is already extremely negative, and that could actually work in the market's favor because we use that as a contrarian indicator. But it's been down here for a long time, and it doesn't seem to matter. It's not a real bounce that we're coming up out of. There hasn't been a real capitulation in the market. It's just we go up a little bit, then down a little bit. People listen to what news they listen to, and they're still not feeling a lot of confidence right now. Then unsolicited positive or negative mentions on the news, heard about government and economic. Yeah. I mean, if you listen to a lot of the mainstream media, they're just bashing everything that's going on. That's their job. That if Trump came out with a cure for cancer, they would be on cancer's side. I mean, you've got people that hate him that much, other people that really like him. We're seeing that declining a lot though lately with the rise of alternative news sources. That's what I do. I listen to podcasts. I listen to different things that over the years I found, okay, this is a reliable source, and I go with that. I don't even watch any of this stuff. But it's losing its popularity and the ratings are really going down, but there's still a lot of people that hear it. And it's like, yeah, okay. All right, so here is the chart going in from Thursday. It was kind of a little bit of a slow day here. We went up at the daily pivot, chopped down, and then came a little bit off the low. And I didn't do a video for Friday, which would have been based on Thursday's chart. That's why I'm going over this. Then we immediately came down. We had a lower open and quickly went down below S1, S2, made it all the way down to S3, which that's not on the software here. So I have to put this line on the chart using a pivot point calculator, and that pretty much set the low for the day, and we stayed right there. And so some weakness here, and things were down a little bit, but we almost got back to the unchanged level, but then we started drifting down. We saw the dip right after the core PCE report came out, and then a little bit of a bounce. And then the cash session here is in this kind of tan area, and then we ended up closing for the weekend. And this is also negative with the red line above the blue line. That means they're both down, but value has been outperforming growth. And we're seeing that here too with the S&P growth to value ratio. We've been going down. End of day charts, the growth was down 2.48% with the large caps, where value got hit too, but was down even about 1% more. We were down more with the mid caps and actually a little bit less with the small caps. But small caps have been so hammered, it's like, is there anything left there? So we look at our small cap growth to value ratio back down here. We've been just bouncing around under the 200-day moving average, back down under the 200-day moving average with the mid cap growth to value, and going back down to the lower end of the range here with S&P growth to value, and back down to the lower range here with the growth to value ETF. It's well below the rainbow, and back down here as well with discretionary to staples. Their staples are holding up as discretionary is getting hit. And so we were starting to look a little more positive. The red line and the green line got pretty close, but not enough to cross. Now we're below the moving average, but if we keep going down like this, especially if we start breaking below these previous lows, this could, and you can kind of see it already, it's starting to turn back up. So it could go back into a strengthening trend. And we're seeing it turning up here on the short-term chart with the red line going up and the green line going down. And we continue to be below average with volume as we see here. Every day this week was below average. Sentiment, we're back above 20 with the VIX. We closed in the 21 range now, and both with the line chart and the bar chart. And so when that goes up, we're seeing the VIX of the VIX lagging a little bit behind the VIX. It's just that the VIX is moving a little bit faster currently. The momentum is still down for the VIX, but this is a MACD, and it can take a little bit of time for this to switch. We had been coming down with the VIX. Now, if we continue to go up, this will roll over, cross over, and now the momentum would be up. But for right now, it's still down. And then we declined to tick down here with this fear gauge, and we went up with the other fear gauge. So a little bit of a contradiction there. And we're keeping an eye on this. This is the spread between risky and not as risky bonds. I'm using this more as a sentiment gauge where we're coming back down, but we're not down to these previous levels yet. Now, when this goes down, that means fear is increasing in the bond market. And coming down a little bit here with, even though it was a down day, we actually declined with the equity put call ratio. So we're still going up with the 5-day chart, and we're going down just a little bit here with the 10-day chart. And this, usually I have it for Friday's video, but these are individual investors, and they've now spent 5 weeks below 50 down here. And I have another little chart to show you about that in a moment. In fact, right here, it's the individual investor bears above 50. That means the bulls are below 50. 5 straight weeks now. What happens going forward? Looking back to 1990, we're higher 100% of the time. 1 month, 3 months, 6 months, and 12 months. We're up, no matter how you look at this. But I wouldn't use this as necessarily, licking your chops and getting ready to go in and buy. I mean, there's other factors that are playing into this. Here's the chart that I usually show where we're down here, actually, we ticked up a little bit right here, but it's still a negative reading overall, even though it's improved a little bit. And we're going back down now with the risk on to risk off ratio, where we were trying to go back up here, but now we're resuming going down. And in negative markets, that's usually what we see. But this is kind of interesting. We're still getting a very low reading with the volatility risk premium. When we start going lower, you would expect this to be higher. This is a little bit like the VIX, but not quite right. It's just what's the premium that's being paid for the risk that you're taking 30 days out. And right now that's very low. But the advanced decline line, it took a hit here on Friday, but holding up for the most part, both based on price and volume. We're coming down, but still positive with the advancers minus decliners over a 10-day period. Still looking pretty good here with the new highs, new lows, another internal measure. We saw some new highs generated, but on Friday we did see some new lows, but we're still going up with the 5-day and 10-day charts. And we were dropping below the midpoint here with the short-term advanced decline ratio. We're still barely above it for the intermediate term advanced decline ratio. And coming down, but still above the moving average with accumulation distribution. So it's still positive, but the context is certainly negative. And we're turning more negative here with the chicken money flow. We're rolling over with the red line. It's actually going down, and we're going down with the chicken oscillator. So if you take the context of accumulation distribution, it's negative. But if you go whether we're above or below the moving average, we're still positive, even though it's showing weakness. But the other two smart money indicators are negative now. And we were showing some improvement with the vortex. Now the red line's going back up, but the green line came back up a little too. And we're below the moving averages now with our advanced decline line studies. Now, when I say it's positive in the previous charts, this is a different moving average than what I show in those previous charts. We're dropping below the moving average and declining with all of the indexes that we follow here. And we were showing some improvement with those stocks in the S&P above their 20-period moving average. Now we're back down below 50. We declined with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. And still below average with volume. We're starting to come into the pivot points now for April, but we're dropping below that, and it makes this a little hard to see. So we're going down with the 20, 50, and 200-period moving average study. We were extreme positive for a few days there with the Stochk RSI. Now we're down, dropping below the midpoint. And for one day, we were positive with the Williams percent R. That's also dropping down and dropping below the midpoint with the CCI 14. And we just barely got above the midpoint before we turned down with the CCI 20. And stochastics in the short term, they were extreme positive there for a day or so. Now they're going negative. We're turning back down here in the intermediate term. And we were just starting to get positive, but now rolling over in the long term. But nothing is extreme positive or negative currently. The force index dropping down below the midpoint, that's negative. And this is the condition of the short-term trend. This had been looking a little bit better. We were above both the lines. Now we're starting to come back down below the lines. And we're below the 20-period simple and exponential moving averages. We were watching this in the short term. If we're above it, we're positive in the short term. Since we're below it, we're now negative. This is another newer indicator. It's called a bow tie, where we have a 10-period simple moving average, that's in green, and then a 20-period and 30-period exponential moving average. Notice how we came right up to the 30 exponential moving average, and that provided overhead resistance. And now we're starting to go back down. And we're below the midpoint. We're in the -2 standard deviations channel. And this is, are we getting close to that 10% decline? After Friday, we're at 9.17% from the all-time high set back in February 19th, I believe. And so if we go above this dashed line, that means we will be in a correction. And for a lot of folks, that changes a lot of things. Instead of just a pullback, now we're looking a little bit more negative. And we're coming right down to the midpoint here with the balance of power. And we're getting extreme already with the Connors RSI. Don't use this one all that much. We're just barely extreme negative. And we're back to a deep purple here with the go, no go. That's more negative. And dropping down below the midpoint with our highest high, lowest low value chart. But the TTM squeeze continues to chug a little bit higher, but it's not really picking up what we're seeing right now. And we're down below this green line, which sometimes that's an extreme negative reading with our rate of change going back 50 periods. So we're somewhat overextended that way. The reason it's not on the chart, I only put this on here when we get below this pink line here. And we're still negative. We were trying to improve with the ease of movement, but not so much on Friday. And we're turning up a little bit here with the Arun, but we're still negative since we're below zero when you measured buyers versus sellers. And we're dropping below zero with the S&P McClellan oscillator. So now we're turning down based on price and volume. That's negative. We're dropping below zero with the NYSE McClellan oscillator. So now we're ever so slightly ticking down based on price and volume for the NYSE. That's also negative. This is the condition of the short-term trend. We came all the way up to this 50-period double exponential moving average. That also was providing overhead resistance, and now we're starting to come back down. And we're below all the moving averages again. We sliced through the 20-period exponential moving average and below the 20-period simple moving average. So yeah, we're losing some support here. And we're getting far away from the 20-period and 50-period moving averages. That's what the boom indicator tries to measure. How far away are we? And we're overextended to the downside. And we're losing support here that we were trying to gain back with the anchored moving averages. We fell back down below the orange and then back down below the slight blue area, which had been kind of significant. When we're below it, it acts as resistance. When we're above it, it was acting as support. Now we're falling down. So that's turning more negative there. And we're below the 200-day simple moving average, so it's red. We're still declining with the Swindlin trading oscillator based on price and volume, and we drop below the midpoint with volume. We're seeing some vulnerability here, but the PMO is still going up, but it's rolling over. We're rolling over based on price and volume, and we're coming down a little bit, but right around the midpoint here with the PMOs that are rising, starting to roll over with the buy signals where we had been seeing some buy signals come in, and we were starting to improve a little bit here with the PMOs above zero. We'll see if that starts to go back down. We're negative with the Elder's Impulse system for the S&P, and after Friday, we now have a dot on top. So the parabolic SAR is now negative. And we're no longer extreme with the slope oscillator. If we see more down days, this will probably start to roll over itself, but currently this is still positive. We're rolling over, but positive with the MACD. Our short-term oscillators, they're not really, the trick, or TSI is picking this up a little bit. We're not really seeing that in the slope. Those are the two short-term oscillators. Rolling over a bit here with the three intermediate-term oscillators, and we're still just trying to turn positive with the tricks and the KST, our long-term oscillators. The copy curve is still positive, and we're coming back down just on the border of this pink area, which is extreme negative with the Sean trend meter. Still below 50 with the money flow, and we drop back below 50 with the ultimate oscillator, and we're right back down to the moving average with unbalanced volume. And we're below 50 with the RSI 14 and the RSI 9. So things are seeing some technical damage here. And why is this other rate of change here? Apparently, you needed to see this 2 times. I already talked about this chart. The bullish percent index, we're negative now. We're declining and below 50 with the S&P bullish percent index. We're back to declining with the NYSE bullish percent index, and we're below 50 and declining with the NASDAQ 100 bullish percent index. We still haven't seen the third part of a signal here. It has to come down to this red dashed line with the mass index, and it's trying to suggest we'll see a reversal. And we're getting a praying bottom fisher signal. This had been going far away, but after Friday's decline, this thing really turned up and is now giving a buy signal. But we're not really, other than sentiment, we're not really seeing anything oversold at this point. So I don't know if I'd put a lot of confidence in this, but it has given us some really good buy signals. It's also given us some really bad ones as well. And we were using this little mini rainbow here as overhead resistance, and now we're starting to fall back down. This is a chart. I just drew this up based on the closing prices for the S&P. You go back to the all-time high that was set in February, and then you go to the current low, and we retraced about 38.2% of that, a little bit above that, but now we're starting to go back down. And that's what a lot of folks are probably concerned about. It's like we're going down, we're going down, going down. And then as we were bouncing back up, it's like, are we going to turn back positive and V bounce out of this? Or are we just retracing a little bit before we're getting set to go even lower? And that's what we're trying to watch with this chart. If we take out that previous low, then yeah, we're going to be probably going lower. And we're down below the 61.8% retracement, but we're still slightly above the 50% retracement here. And this goes from the low set a year ago, April, to the all-time high. And we've given up just about half of those gains. But we're still, believe it or not, we're still above this long-term pivot point here on the weekly chart of the S&P. This pivot point is at 55.75, and we closed at 55.80. So, I mean, 81 if you round up. I mean, we're 5 points above it. So, I mean, it's not like, whoo, it's like It's a Wonderful Life and they march into the vault with $1, okay, because they're still solvent. We're still hanging on to this. We'll see if that ends up meaning something or if we break down below it. That could be more negative naturally. And we're turning more negative with our trends. Here with the Heiken Ashi, that's negative. We're turning red with the Kegi, that's more negative. We're still positive with the Renko chart. It didn't pick up anything yet. And we're still positive with the three-line break. So those haven't actually switched over negative. We're getting a mixed picture with these charts. Enough of a down day on Friday to have three O's drawn in here. That's negative too. And we're falling further below the midpoint with the 150 and 200 period moving averages. And we're still negative in the short and intermediate term with all the different indexes. Bonds are now negative in the short term based on price, positive in the intermediate term. Commodities, and this is where some of the inflation fears are coming from, they're doing pretty good right now. But I'll be going over that in the weekend videos that talk about these different ratios. And what we look at as other ways is how is the market perceiving inflation? It's one thing to say, I'm worried about inflation. It's another thing to, okay, what's the market think about inflation and trying to judge it from that way. The only sector that was up was a defensive area, and that was utilities. Now, you could always make the case that utilities are growth because all this electricity that's needed for AI and for electric vehicles and all this stuff, that would make it more of a growth area. But typically, this has been more defensive. We had discretionary and communication leading things to the downside, with tech in third place. All these just got hit. The three big growth areas that we need to go up went down the most. Other than a Staples bullish MACD crossover, which is actually negative for stocks, that's defensive. Everything else was red, with the NASDAQ going below 19.8, 19.7, 19.6, 5, 4, okay, 3. Not quite at blast off yet, but a lot of damage. Communication, that's growth. BPI crossed below 70, Dow falling below certain levels. Canada having a little bit of trouble. Industrials, BPI crossed below 50. That's more economic. That's negative. We crossed below 50. I already went through that. Discretionary below 50. So yeah, some damage was done in Friday's session here. And we're back down below the 200-day moving average with the Dow, and we're negative with the diamonds with the Elder's Impulse system. Coming down to this S2 support level here with the NASDAQ. Are we going to be able to hold on to some support, or are we going to continue to go down? And same thing, back down to this area. This is a pivot point here, and this has provided some support We fell below it a couple of times there, but if we break down below it, that's going to be more negative. And we're negative with the Elder's Impulse system for the Qs. The momentum is positive, but rolling over now. Could be turning negative very quickly. And small caps just not doing very good these days. And we've seen a recent death cross here with the longer term trend. Also, with this other small cap index, we're seeing a recent death cross coming down below 50 with the RSI. Positive, but rolling over with the momentum. And we're negative with the Elder's Impulse system for the small caps. Just about ready to generate a death cross here with the mid caps, unless we get above these lines really fast. And we're negative with the Elder's Impulse system for the mid caps. We're down below the 200-day moving average again with the Wilshire 5000, a broad market measure, and we're falling down as well with the other broad market measure, the total US stock ETF. Financial sector, it regained its 50-day moving average. Now it's losing it again, and we're below the 200-day moving average with the bank ETF. FANG index holding on to its 200-day moving average, now falling down to the lower end of this range that we've been at lately. And let's see, Amazon was down 4.29% below its 200-day moving average. We're in a downtrend with Microsoft and down over 3%. Apple was also down 2.66%. It could be getting ready to see a death cross as well. Google below its 200-day moving average, and we're seeing the trend threatened. Coming down to the 200-day moving average with Meta. And this has been one of the areas that's been holding up a little bit better. But if that drops below its 200-day moving average, that's going to be more negative. NVIDIA, we're seeing a death cross now below its 200-day moving average. Tesla came back up to its 200-day moving average. Now it's falling back down. Netflix, also probably one of the better looking charts, still holding out around its 50-day moving average. And we're seeing this spike go back up. I was talking about how this was positive when the staples to tech ratio goes down. Now it's going back up, and that's negative. And we're seeing more of a neutral correlation in the short term between US and world stocks. We're still seeing a deterioration of US to world stocks longer term. World stocks are actually they're holding up better than US stocks right now. And we're still below 70 with oil. That hasn't really spiked up yet. And we're still below the 200-day moving average with the dollar. And we came down with the 10-year yield. We were up with the 10-year based on price, and we're back to inverted again. We're minus 0.05 here with the 10 to the 3-month yield curve. We've been kind of peaking. We go in, then we go out, then we go in, then we go out. We're back in right now to being inverted and seeing some damage here after we had been seeing a little bit of improvement with our growth to value ratios. Qs to S&P down, dropping below the moving average with discretionary to S&P. Large cap growth is underperforming large cap value. So large caps, mid caps, small caps, weakness across the board there. And we're going down here with the S&P to utilities ratio. It's more positive when we go up. And we were coming down here with the staples to S&P ratio. Now it's going back up, which is more negative. So what's the outlook for Monday? We are negative in the short and the intermediate term now. The long term is mixed. And for right now anyway, the long-term support is holding by 5 points. And we're going to get the Chicago PMI in Monday's session, and then anything geopolitical, whether it has to do with the tariffs or, there's a lot of crazy things going on in the world that could escalate at any time. Here's the economic calendar for the upcoming week. We're going to get ISM manufacturing on Tuesday, and we're going to get ISM services on Thursday, and then we get the big employment report on Friday. And on Friday, Fed Chair Powell is going to be giving a speech, and the market listens whenever he talks. Here's also another look at the economic reports calendar for the next week. Seasonally, not much of an edge either way for March 31st. We're coming out of options expiration week where we tend to be down a lot more than up. Yeah, that happened this time. But we're neutral to negative with the Dow and S&P. We're neutral to positive with the NASDAQ. And here we're finally finishing out the month of March, and we do see a little bit of positive seasonality when it's a post-election year. So now, okay, these are in the wrong order here. Our smart money indicators, we're still above the moving average with accumulation distribution, but the context is down. So you might decide to think that's negative. Where we are declining with the Chaikin money flow and the Chaikin oscillator, we're negative with the S&P and NYSE McClellan oscillators and summation indexes. Swollen trading oscillators negative. The parabolic SAR, that's new on this list now. And the bullish percent indexes are also on this list of being negative. The moving average studies are all below 50. Ease of movement, money flow, ultimate oscillator, all negative. The vortex is still negative. It was really seeing some signs of possible improvement, didn't follow through. And we're still long-term negative with the special K oscillator. All right, positive side. Now, longer term, we're still in uptrends with our growth to value ratios, but they're all sitting around their 200-day moving averages. And discretionary to staples, also down around its 200-day moving average with the ratios. That's more negative. The oscillators for the S&P are still mostly positive, but they are showing some signs of weakening. The copy curve is still positive. Financial sector is still positive, but we dropped below the 50-day moving average and we're below the 200-day moving average with the bank ETF. And we're still positive with the momentum of the NASDAQ 100, but it is weakening. So our conclusion, we're negative in the short and intermediate term, where we're mixed in the long term because we dropped below the 20-period simple moving average. And we're just flat out negative right now in the intermediate term. And we're still positive, but we're below the 200-day moving average with the long term. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.